What if one of the world's biggest banks suddenly collapsed? Introduction. What if one of the world's biggest banks suddenly collapsed? In the first few minutes, most people might think that this was a problem that only affected the bank's customers. But in reality, the situation could be very different. Because a large bank is not simply a place where people keep their money. It provides loans to companies. It finances home and car purchases. It buys government bonds and financial assets. It becomes part of the salaries of millions of people, company payments, and everyday economic activity. For this reason, the collapse of a major bank could have consequences far greater than the bankruptcy of a single company. So what would really happen if something like this occurred? What would happen during the first few hours? Would people rush to withdraw their money from banks? Would other banks also be put at risk? And most importantly, could the global economy withstand such a shock? Today, let's examine this scenario step by step. The first hours. Everything could begin like a normal day. People go to work, stores open, companies make payments. The banking system continues to operate. Then a piece of news appears. One of the world's largest banks announces that it is experiencing serious financial problems. At first, most people might not understand what this really means, but financial markets react much faster to the news. The bank's stock price begins to fall. Investors start questioning the bank's financial condition. Customers check the money in their accounts, and some people may begin moving their money to other banks. This is where the critical point appears. When fear about a bank begins to spread, people may all want to withdraw their money at the same time. Banks do not keep all of their customers' money as cash in their vaults. A significant portion of that money has been distributed into the economy through loans invested in different financial assets. Therefore, if everyone wanted to withdraw their money at the same time, the bank could face a serious liquidity problem. What if a bank run begins? This is known as a bank run. In the past, people would form long lines outside bank branches. Today, the situation could happen much faster. People do not even need to go to a bank branch. They can transfer their money to another bank within seconds using their phones. A single rumor spreading on social media could cause thousands of people to check their accounts at the same time. One person transfers their money to another bank. Then someone else sees this and does the same thing. After that, hundreds, thousands, or even millions of customers could make similar decisions. As a result, a problem that initially seemed small could grow rapidly. Even if the bank's financial condition was not actually as bad as people believed, excessive withdrawal requests could put enormous pressure on the bank. Why would other banks be affected? Here's the most important question. If one bank collapses, why would other banks be at risk? Because banks are not completely independent from one another. Banks can lend money to each other. They can hold each other's securities. They can provide loans to companies together. They can operate in the same financial markets. In other words, the failure of a major bank could put pressure on other parts of the financial system. For example, if the failed bank owes large amounts of money to other banks, it may no longer be able to repay those debts. As a result, other banks could also lose money. Other banks could also lose money. And if they begin to believe that they are at risk, they may start reducing the amount of credit they provide. At this point, the problem is no longer just the problem of one bank. Pressure begins to build across the entire financial system. What if the credit lines dry up? One of the most important functions of banks in an economy is providing credit. If a company wants to build a new factory, it may use a bank loan. An entrepreneur may seek financing to expand their business. A family may use a mortgage to buy a home. However, when banks become afraid of a major crisis, they may reduce lending because it becomes harder to know how much money they could lose in the future. This can cause the economy to slow down. Companies may postpone investments. Fewer new businesses may open. Some companies may reduce the number of employees. Consumers may also begin spending less. And this is how a financial crisis reaches the real economy. What happens in the stock market? News of a major bank's collapse could trigger a massive wave of selling in the stock market. People may begin selling not only the bank's shares, but also shares of other companies, because investors start asking, if this bank is in trouble, which other companies could also be at risk? This uncertainty is extremely important for financial markets. When investors cannot see what the future holds, they usually become more cautious. Some may prefer to hold cash. Others may move toward assets they consider safer. Some may leave the market completely. As a result, stock prices could fall rapidly. What if the central bank steps in? In such a situation, governments and central banks would generally try to calm the financial system. A central bank could provide short-term liquidity to banks. The goal would be to make sure banks can meet their customers demands for withdrawals. Governments could also announce various measures to protect depositors. Because people's confidence in the banking system is extremely important. If people believe their banks are safe, the system can continue operating normally. But if confidence disappears, even the strongest banks can come under pressure. That is why during a crisis, it is not only money that needs to be managed. Confidence needs to be managed too. Would the government rescue the bank? This raises another question. Why would a government rescue a bank that has failed? Because the collapse of a major bank could affect millions of people and companies. The government's goal would not necessarily be to make the bank's owners richer. Instead, it could be to prevent the financial system from completely losing control. To do this, the government could provide capital support to the bank. It could encourage the bank to merge with another financial institution. Some of its assets could be guaranteed, or certain parts of the bank could be transferred to another institution. However, there would also be a cost, because in the end, part of the cost of a bailout could fall on the public budget. That is why banking crises often become political debates as well as economic ones. What happens to people's money? The failure of a bank does not automatically mean that customers will lose all of their money. In many countries, there are systems that protect deposits under certain conditions. However, the limits of that protection can vary depending on the country and the type of deposit. This means that when a major bank collapses, not everyone is necessarily affected in the same way. Some customers may receive protection more quickly. Some accounts may take longer to resolve. Large companies and institutional investors may face different risks. That is why the effects of a financial crisis are not the same for everyone. Could the crisis spread around the world? Yes, because today's global economy is deeply interconnected. A major bank in one country may also operate in other countries. It may provide loans to international companies. It may conduct foreign currency transactions. It may work closely with financial institutions in other countries. Because of this, a crisis can cross borders. For example, problems at a major European bank could affect investors in the United States. It could create selling pressure in Asian markets. It could cause volatility in foreign exchange markets. And within a few days, the event could become a global financial story. How would people's daily lives change? It is easy to think of a financial crisis as something that only happens on stock market screens. But the real effects can appear in everyday life over time. Getting a loan could become more difficult. Interest rates could change. Companies could reduce their investments. The number of job opportunities could fall. Consumers could spend less. The housing and automobile markets could slow down. Some products could become more expensive, while demand could fall in certain industries. In other words, a problem that initially appears to be limited to the banking system could eventually affect the daily lives of millions of people. What if a bigger crisis begins? Now let's take the scenario a little further. Suppose the first bank could not be rescued. Then it becomes clear that other major banks are also experiencing problems. Investors panic. Companies struggle to find credit. Consumers reduce their spending. Banks become reluctant to lend money to one another. In this situation, the economy could face a serious risk of recession. Because for an economy to function, money needs to keep moving. A company pays its employees. The employee shops at a supermarket. The supermarket pays another company. The company takes a loan from a bank. The bank provides financing to another business. When an important link in this chain breaks, the effects can spread to other parts of the economy. Why do people panic? One of the most interesting aspects of financial crisis is that the economy is not made up only of numbers. Human psychology also plays a major role. A bank can be strong because people believe it is trustworthy. But if people suddenly lose confidence in it, the situation can change. That is why in the financial world, trust can be just as valuable as money itself. A rumor can affect millions of people. A news report can change investors' decisions. And in the age of social media, this information can reach every corner of the world within seconds.